Should we care how the market performs on any given day? Can you move an IRA from one broker to another, and if so, how do you do it? And what accounts should you tap first in retirement? We'll answer these questions and more on this, the 38th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is a podcast to help you take your finances to the next level. Welcome to day 31 of the 31-day money challenge. It's been a fun month for me. It's been an exhausting month. I'll tell you, one of the things that has kept me going is all the great questions and email and comments on the blog that I've received from all of you. Just some wonderful questions, very insightful. I mean, folks have emailed me their investment portfolio, their asset allocation, their views on investing. Some of them have, disagreed with my views, which I think is fantastic. You've got to do what you think is right for you, whether it's what I think is right for me, and just a lot of overall great questions. And in fact, I decided to dedicate this last day of the 31-day money challenge to answering more reader questions. They started to pile up on me. I like to kind of answer them as soon as they come in, but sometimes it's just not possible. And for a while I was, answering one or two per show, but then here towards the end, they started to pile up on me. So I've got a handful of questions that have come in. I believe I've emailed everyone already that has emailed me, but they were great questions. I wanted to share them with all of you. By the way, if you shoot me an email and a couple of days go by and you haven't heard from me, as I've mentioned before, I respond and read to every email. So it could mean that I've missed it. It could mean it ended up in my spam folder. It could mean that I planned to respond to it and I just got buried. It could mean that you've asked me a tough question and I'm still doing some research. But whatever. Feel free to ping me again. I get that from time to time, and I'm not leaving you out on purpose. So please don't feel that I am. I do read and respond to every single email. So that's what we're going to do today. We're going to take a look at some listener questions, and I'll give you my thoughts on the various situations that they're all facing. So that's our game plan for today. Before we dive into it, let me thank our sponsors again. Without these two sponsors, the 31-Day Money Challenge wouldn't have been possible. They were very helpful and supportive. And as I've mentioned in the past, one of the things that I liked so much about working with Betterment and Personal Capital is they had absolutely zero influence on the editorial content of this 31-Day Money Challenge. They didn't ask for anything. I mention them at the start of each podcast, as you know, and link to them in my newsletter and whatnot, but they didn't ask for anything. They've never tried to have any influence whatsoever on the editorial content of my blog, my newsletter, or this podcast. Of course, I wouldn't let anyone do that, but I just thought I'd mention that. I think it really speaks to the character of an organization when they're willing to sponsor something like this and then just step back and let it happen. So with that, real quick, Betterment, as you've heard during this 31-Day Money Challenge, it's an online platform that invests your money in both stock and bond ETFs. You can make automatic deposits, which is what I do to my Betterment account every month. They will then take that money and they will invest it for you based on your allocation. They'll rebalance your portfolio automatically and reinvest your dividends automatically as well. And if you've not been to Betterment, they have a really cool interface. It makes investing very, very easy. You can check them out at betterment.com. And our second sponsor is Personal Capital. I've used them for quite some time now. It's a free online tool. You can aggregate all of your investments. You can include both your retirement and your taxable accounts, 401ks, IRAs, Vanguard, Fidelity, all your brokerage accounts, Scottrade. And they will bring those all together and show you your performance across all of your assets. They'll show you your asset allocation as well as the fees that you're paying, with a lot of very helpful charts and graphs and spreadsheet type visuals. Very easy to kind of get a sense as to where you stand. They'll also show you how much your 401k is costing you and how that will affect your performance over time. A really neat tool that they have there. I highly recommend you check it out. You can see them at personalcapital.com. Okay, let's dive right into the questions. The first one comes from a listener named Luke. And he writes and says, I've recently subscribed to your podcast and have really enjoyed the content. Thank you. I'm a beginner investor, early 30s, enjoying the learning process. My question for you is this. Why does the investment community publish daily market movement of indexes like the Dow and the S&P 500? My understanding is that these indices are just a large sample of similarly sized companies. Why does it matter to you or me that the entire index is up or down 5%? Well, that's a great question, and I as I thought about it, I'm kind of two minds. On the one hand, its movement on a given day shouldn't matter. On the other hand, well, it kind of does. So part of it depends on how you invest. If you invest, say, in individual stocks, and you have 5 or 10 stocks that comprise your portfolio, then how an index performs in and of itself isn't all that important to you. Now, the overall movement of a market can cause stocks to move up and down for reasons that aren't specific to a company, right? And we've certainly seen that this week as the market, has been largely down and then back up a little. And when you have these big market swings, it affects all of or virtually all of the stocks in, say, the Dow or the S&P 500, but not all of them. And so, yeah, if you're investing in individual stocks, what you really care about is how those companies are performing as opposed to the market as a whole. But for a lot of us, we invest in index funds, right? So we either have a total stock market index fund. We've talked about that during the 31-day money challenge, or we have one tied to the S&P 500. And there are other indices, of course, for foreign stocks and small caps and on and on. And so if you invest in a fund like that, your fund, the mutual fund is going to track the performance of that index, usually just a tad below it, because of the small fees that these funds charge. Again, they're usually 5 or 10 or 15 basis points, relatively small, but your fund is still going to track more or less the index, and so you do care how the index performs. Now, whether you should be watching it day by day is a whole other matter. I tend to now simply because I write so much about investing, but before I did that, I didn't, I'd notice the index maybe if I saw it in the paper or on the news, but I wasn't tracking it every single day. And, you don't have to. There's no reason to, but it certainly is important for that perspective. And the other thing these like a Dow or an S&P 500 index will do is just give you an overall indication of how the market is performing. And, you've heard me sort of be critical of some of the commentary. Everyone has an explanation. The Dow is down because of fill in the blank. Something the president said, something the Fed chairman said, something that's happening over in Europe because the GDP came out and surprised everyone. Unemployment went up or went down. All these different factors in it, and they're certainly from a sort of a macroeconomic perspective. They can be interesting for some to follow. Do you and I need to be successful, long-term, passive index fund investors? Absolutely not. So that's my kind of response to Luke's question. I do think those that, if you're sort of on the edge of your seat every day to see how the market's performing, I guess if that doesn't cause you to make mistakes with your investing, that's fine. If you just watch it, but you don't run out in fear and sell and change your plan because the market is down or out of greed because the market's up, maybe it's just of interest to you. But if it's driving you crazy and keeping you up at night, you might not want to pay so close attention to it. So that's my response to Luke's question. Next question comes from Kenneth. He and I have had an interesting dialogue back and forth really throughout this month, and some great observations that he shared with me. And I wanted to read this email. It's kind of interesting. He says, I know you own a portfolio of individual stocks, including Apple. If you read the link below, and by the way, it was to, I think, a Wall Street Journal article. I read it at the time, but this has been a couple of days ago. Anyway, if you read the link below, it's a good analysis of why Apple is down big today after its earnings report. A few weeks ago, I recommended you read, when you have the time, Jim Collins' stock series, and I'll include a link in the show notes to that. Jim is a good friend of Mr. Money Mustache. He's also been compared to Warren Buffett, not in amount of capital, of course, but for his views on stocks and markets. Jim also admits I like the word admits. Jim also admits, as a lawyer, that word has all kinds of meaning to me, right? Jim also admits to having 5% or so in individual stocks as play money. I'm just saying that, in my view, you can't know which stocks are going to outperform the market in a year. I've tried. I can't do it. You yourself have pointed out that actively managed mutual funds can't beat the S&P 500 year over year. And he goes on. He goes, I can beat the Mirage Casino for one session, one trip, etc., but I can't beat them over time, so I quit playing there. To cut to the chase, my advice for you would be to reduce your individual stock holdings to less than 10% of your portfolio. Fun money, if you will. Well, I don't disagree with anything that Kenneth says. In my case, my individual stocks are more than 10% of my portfolio, probably around 20%. I don't have any plans to change it. My view, I preach the sort of long-term passive index fund investing, so you may say, well, why in the world do you have individual stocks? Well, it all started when I opened up my SEP IRA at Scottrade, and I thought, I think I can be a successful investor in individual stocks. And the reason was not because I have some great insight into companies that no one else has, that I know more than the next person in terms of evaluating a company. I certainly have some background in evaluating financial statements, but I don't profess for a minute to have some, secret sauce, some, insight that no one else has about financial statements. But there are two things that I do bring to investing. One is I don't trade on sort of momentum. I don't get caught up in the Facebooks and the Twitters of the world, or the Amazons for that matter, which is trading at over, I think its PE is over 1,000 if I recall. I don't get caught up in that kind of investing. I'm much happier generally investing in boring companies. Now, I do own Apple. I don't view Apple as a boring company, although it certainly has been beaten down. There's no question. So that's the first thing. And the second thing is I'm willing to stick with my investment decisions even when the market disagrees. So, for example, as Kenneth alluded to, Apple's been down. I think it's a great company at a great bargain. I'll probably buy more. I think, does it have competition? Sure, it does. But it's got an incredible brand, an incredible product, incredible cash flow, and it's trading at around 13 times earnings. And so for me, it's a good buy. But to Kenneth's point, I don't go over about 20% of my portfolio, and I'm comfortable doing that. But for most people, frankly, just sticking with the Vanguard low-cost mutual funds is a great way to go. I certainly agree with Kenneth. The vast majority of people should not be investing a large portion of their portfolio in individual stocks. Okay. The next question comes from a reader named Kevin, and it's a fairly long email, and so I'm gonna summarize it. But here's there. He says, "Hi Rob, I found your podcast at the first of the year, and have been listening to your 31-day money challenge. I think your material is great, even though I mostly follow your money ideas you teach. Thanks, just being turned on to investing when I was 15 years old. He's currently 34." And took an interest in reading money books and listening to other money podcasts like yours. And he also mentions a few others here, Clark Howard, Brian Preston, and recently YoPro Wealth. Interestingly, I spoke with Austin of YoPro Wealth yesterday, just as an aside from Kevin's email, and he interviewed me for his podcast. So you'll hear that interview. I think he said it'll go up in about 3 weeks, but I'll link to it when it comes out. Anyway, Kevin goes on. But there's one thing that the other podcasts were not able to convince me of that I think you did. In parentheses, he writes, "I hope!" ! That is, should start to manage my own money outside of my 401k. I'm a little scared. I don't want to screw it up. And he mentions he's currently with a financial advisor who's managing his money. I won't go into the names, but charging him about 1.25%. And as I move down, he says, any suggestions on how and if I should make the switch from this money manager over to, say, Vanguard? I'm thinking about just leaving the money there for now and stop adding to it and starting a Vanguard account and add monthly to that instead and dollar cost averaging and compare the returns quarterly, me versus his active money manager. But I also like that there is always a money guy to call for advice that knows me personally versus just going on the web for an answer. So I'm torn. Would love to hear your thoughts on this. Well, I emailed Kevin back, and I think it's a great question because he's really trying to evaluate his own views of investing, his own concerns, and it's very specific to him. You may or may not share the concerns that he has. You may or may not want someone that you can get on the phone with and talk about your investments. That may not be a need for you, or in Kevin's case, maybe it is. And I thought that his approach to maybe leaving the money where it is and starting slowly in Vanguard to see if he's comfortable with it, I think that's a great idea. I mean, yes, he's going to continue to pay what I think are very high fees for where his money currently is. But he may just need some time to get comfortable investing on his own, and I think that's okay. One thing I did mention to him, though, is, Vanguard has some great people. They'll talk to you about your asset allocation. I've spoken to them before for myself. I've helped family members. I've gotten on the phone with family members and Vanguard, and they will walk through their suggestions on asset allocation. Of course, the level of service varies depending on how much you have invested with them, but they will absolutely get on the phone with you and talk with you about investing options and asset allocation and all of that. So take advantage of that if that's where you are. And again, I think in Kevin's case, if he wants to kind of start slowly investing on his own, he's not quite sure if that's right for him. I think that's great. At least here's the key. He's identified the issue, in this case, fees. He knows it's an issue, and now he's just trying to figure out the best way to address that in his own portfolio, and he's being cautious. And I think that's that's half the battle right there. So that's my response to Kevin, and I wish him the best. Okay, let's see here. Steve, a reader named Steve wrote in. He said, I found your show mere days into your marathon month of podcasting and love it. I have greatly enjoyed and learned from all of your broadcasts. I can't reasonably expect you to continue this pace beyond this month, but great job so far. And then he had a comment about one podcast, and then I'm going to skip down to sort of his question. He said, I have a selfish, although not unique request, and one that perhaps is covered in a podcast I haven't reached. He was, I think, on number 21. As many of your podcasts focus on retirement planning, I'm curious what advice you have for me and others who do not plan to retire and kind of dislike the notion. Steve goes on, he says, I love what I do professionally, and retirement is linked to in many studies to decreased income, worsened health, reduced mental acuity, increased loneliness and depression, and even possibly increased risk of suicide and earlier mortality. I'll pass as long as I can do any work at all. I am curious if you recommend foregoing retirement entities like IRAs over other investment strategies and other thoughts you have on how to structure finances and investments with the hope and expectation of lifelong work. Thanks for your time and podcast. I look forward to hearing and learning more. That's a great question. One of the things that underscores is everybody's different. Some people want to retire early. Some people never want to retire. There's no right or wrong answer. When people say to me, I want to retire early, my first question is, and then what? And sometimes I don't get a pretty clear answer. I mean, early retirement, in my view, is not an end in itself. There may be things that you want to accomplish in life, passions you want to follow, things that you want to do, and they require early retirement. And that's great. If they are, you'll be able to articulate those things for yourself, and that'll be your goal, and it could be a great goal. Some people absolutely love what they do, and they don't want to retire. To me, that's really the sweet spot, when you can do what you love to do and make a living doing it. And if that's the case, for me, folks that retire early, they may have not hated what they did, but they obviously didn't love it to the point of continuing to do it when they didn't need to, right? Otherwise, they wouldn't have retired early. But to Steve's question, if you don't plan to retire, you're going to work as long as you can. Should you bother with 401ks? Should you bother with IRAs? I think the answer is absolutely yes. Now, yesterday, I kind of gave my views as to the approach to 401ks and IRAs. And you can read that for more details. But first of all, if you've got a 401k where your employer matches, it's free money. Why give it up? And even if you don't plan to retire, once you turn 59 and a half, you can start withdrawing from your 401k or your IRA without penalty. And between your contributions and when you start to withdraw funds in retirement, for a traditional 401k or a deductible IRA, your money grows tax deferred. So why not take advantage of it? And, you may, depending on your income, you may decide on a Roth IRA or a Roth 401k. And in that case, you don't get the tax benefit up front, but your money grows tax-free. So even if you're going to keep working, to me, these are just tax-advantaged accounts. And I think they could certainly be a part of, of your overall investment strategy. And, since you're working, presumably you're not going to need the money before you're 59 and a half, so you don't have that concern about how can I get money out before then without paying a penalty. And so I still think they would be great vehicles for investing. That's my view. The next comment, it's actually a comment, not a question, comes from a reader. They gave me their initials, CB, and they write, in reference to the one-and-done method of saving money, and you can find that at DoughRoller.net /podcast13, Yes, exclamation point. I completely agree. I've always called this, quote, limiting my fixed expenses, end quote. If you set up a few of these things right, you put your low-cost lifestyle on autopilot and make it super easy to cut back in case of an emergency. Change of income. It's my number one budget priority. CB, I appreciate the comment. If you haven't listened to that podcast, I highly recommend it. Again, it's podcast 13. And it basically talks about how you can make simple one-time changes in your monthly expenses and save money month after month after month. We did that recently with our cable, got rid of our digital video recorders, don't miss them, and save $50 a month, $600 a year. You put that in an investment account, it grows, compounds. It's a very significant amount of money over the long term. And the great thing about it is we didn't have to make dramatic changes to our lifestyle. We made one simple change one time, and we save money every single month. All right, so the next question comes from a reader named Teresa, and here's what she writes. She says, I've been enjoying your blog for a little over a year now and definitely been enjoying the podcast. I believe that I have my accumulation figured out, but the planning for I'm just going to try this, withdrawals, I'll change the word, is what I'm trying to figure out. I would like to hear what you plan on doing to get your buckets, 401ks, IRAs, taxable accounts, etc., prepared for retirement, and which ones you'll tap and in which order. Well, apart from the fact that I just obliterated Teresa's question, I think you get the gist. When you hit retirement and you need to pull money out to live on, where are you going to take it out of? Traditional 401k, Roth 401k, deductible IRA, Roth IRA, taxable accounts. Now, in my case, I'm a few years away from that, so it's not something that I've given a lot of thought to. But to answer her question, I spent some time doing some research and just kind of thinking through the issues. So a couple of things here. First, one thing to remember is eventually, depending on the type of retirement account you have, there will be a required minimum distribution, say from a traditional 401k or deductible IRA that hits around 70 when you hit 70 and a half. And so you'll have to make sure you comply with those RMD requirements. Second thing I'd say is, taxes are not the only consideration here. It's going to be the most significant one, I think, and I'll talk about it in a minute. But there can be some estate tax issues that you want to consider, and that particularly comes into play with taxable accounts and Roth type accounts. And I'm not going to dive into those issues. I am not an estate tax expert at all, but it's something that to be aware of. And if it's something you think may be an issue for you, to reach out to an attorney or an accountant that can help you with that. But, for most folks, you've got these options. Where should you begin? And sort of the general rule for me is, what can I do that will keep my tax bill the lowest, right? So if I'm pulling out of a traditional 401k or a deductible IRA, I'm going to have to pay ordinary income tax on the money that I take out. In contrast, if I pull out of a Roth IRA or a Roth 401k, I don't have to pay any taxes. Now, compare those two to a taxable account. I'm likely going to have to pay taxes, but not on everything, right? I'm not going to have to pay taxes on my initial contribution, but I will have to pay taxes on my gains, and that'll just vary from one investment to another. You may have investments that have accrued a lot of capital gains, build up, and when you sell a portion of your investment, you'll end up with a lot of taxes, but they could be long-term capital gains taxes, which could be less than your ordinary income rates, depending on your specific circumstances, also in part depending on where you live. On the other hand, you may have investments that have been throwing off a lot of dividends each year, and so your basis has slowly crept up, and maybe the tax impact isn't as significant. I'll tell you, in Vanguard, they will tell you your cost basis of every single investment. It's very easy to follow, and you can see what the consequences will be. The last thing I would say, though, in response to this question is, you need to consider both your tax bill for the current year and for future years. And here's what I mean. You may have a year when you first retire where you won't generate a lot of taxable income except for what you pull out of your retirement funds. Maybe you've retired, but you're not yet receiving Social Security, and maybe you can live off of money you have in a savings account for a year, and so that you could actually go the whole year without any paying any taxes or very little. Well, in that case, you might want to pull out of a traditional 401k or deductible IRA some money because, yes, you'll get taxed, but you'll get taxed at lower rates. Again, it's going to depend on your specific situation. It's also another factor is going to be what state you live in and what the tax consequences are for where you live. But you might want to take out money that ends up triggering some taxes because your tax rates, your tax bracket for that year will be quite low. This is really where it can help to consult a tax accountant, and that's certainly not my area of expertise, but it's something to think about. Now, if you're starting to get Social Security benefits and you need to pull money out of your various accounts, I tend to think what I'll do, and I'm not there yet, but what I'll do is delay my tax bills as long as I can. Now, I've heard some talk about, no, keep your Roth money in there as long as possible because it grows tax-free. That may be the best option for you. But remember, if doing so causes you to pull money out of a deductible IRA or a traditional 401k, you're going to get hit with taxes that year immediately. But again, so much of this is going to depend on your specific circumstances, your other income that will be taxed, what your tax rates are, both at the federal level and the state level. The right answer for you can get very complicated. So this is probably a long way of sort of pointing out some of the factors you should consider without giving you a clear answer. This is something I'm going to spend some more time looking at, and I think I'm going to try to find someone that I would view as an expert in this area to bring on the show and to interview them and get their views on this, because Teresa's question is a very important one for those nearing retirement. And by the way, if you happen to be that kind of expert or know someone, feel free to shoot me an email, dr@doughroller.net, because if you've got the expertise on this, I'd love to bring you on the show so that you can share what you know with everybody on this very important topic. Our final question comes from a listener named Kate, and she asks a really good question. And she starts out, she says, "Let me start by thanking you for this podcast. I can't imagine how much of your own time you give up to help perfect strangers. You have certainly earned my respect and gratitude." And for that, Kate, I really appreciate it. It's been a lot of fun. I really enjoyed it. She goes on, and then she asks, she goes into some detail that I'll kind of skim over, but basically her question is this. She says, so we went with, and I'll leave out the financial advisor, but they went with a fairly well-known financial advisor for an IRA. Now I realize the true cost of investments and want to switch all of our money to Vanguard funds. We paid front-loaded fees, and we're told our mutual funds cost 75 basis points, plus I believe costs for buying and selling that happens within funds. My question is, can I change our Roth IRAs from this financial advisor to Vanguard? Our financial advisor has been less than helpful, so I don't know how to accomplish this. And great question. So front-loaded fees, let's talk about that first. There are some mutual funds where you actually pay a pretty hefty fee just to buy the thing. Now, these were more common 20 years ago when I started investing with the rise of index funds and places like Vanguard. You'd think these things would be dead finally, but unfortunately they're not. So if someone wants to charge you 5 or 6% for the privilege of investing in their mutual fund, thanks, but no thanks. So I think Kate is right on the money to get out of that situation. And it's a little discouraging to hear that her financial advisor is dragging their feet to help her. But here's the thing. And this is what I suggested she do. Don't call your current financial advisor. Call the place where you want to transfer your IRA, in this case, Vanguard. Vanguard has an entire department dedicated to transferring assets from a different financial advisor over to Vanguard. They'll take your information, open an account for you, and they will initiate the transfer. It's very easy. I just did it less than a month ago. I moved my SEP IRA from Scottrade to Vanguard. I was thrilled with Scottrade. I think they're a fantastic broker. Very happy with them, but I wanted to simplify things, and so I made that switch. I didn't call Scottrade. I called Vanguard, and they initiated the transfer and took care of all of the work. It was very easy to do. And then you don't have to deal with your current financial advisor dragging their feet because they don't want to lose the assets that they're managing for you. So give Vanguard a call, and they will no doubt help you out. So that's what I would do. And Kate, I hope it works out for you. Well, that brings this show to a close, and it brings this 31-day money challenge to a close. I hope you found it helpful. And I'll have links on the site where I've got a page set up where you can see all of the podcasts. There are links to all of them. And can work your way through. As always, if you have questions, let me know. I am going to, of course, continue podcasting. It's just not going to be on a daily basis, probably more like a weekly basis, although I confess I may take next week off. But I will be back. I've got a lot of interviews scheduled. And on that score, if you've got a story to tell, you've got some questions you want answered, you have a success story you want to tell, maybe you got out of debt, maybe you improved your credit score, maybe you started investing and came up with a good asset allocation plan, and you'd love to tell your story online here, I'd be happy to interview you. Just shoot me an email and let me know what your story's all about. And if it's a good fit, I'd love to talk to you about coming on the show. But I'm going to have interviews coming up with other folks, some authors and other things. And when it comes to money and moving towards financial freedom, there's always something to talk about. So that's what I've got planned. Like I said, I'll take next week off, but after that, on a weekly basis throughout 2014. And that brings the show to a close. As always, you can get the show notes. Just go to DoughRoller.net/podcast. Let's see here. Podcast 38. Man, it's hard to believe. The number moved up quick this month. Podcast 38, you'll find the show notes. You can subscribe to this podcast. Just go to DoughRoller.net/iTunes. Love to hear your reviews of the show, so leave a review on iTunes if you would. Helps me make the show better. And you can subscribe to our newsletter. Just go to DoughRoller.net/newsletter. It takes you all of 10 seconds. It's free. It goes out every Saturday, packed full of resources and tips to help you make the most of your money. As you can tell from this podcast, I love email. I read them all. I respond to them all. Feel free to hit me up with an email at dr@DoughRoller.net. So until next time, remember, the best thing money can buy is financial freedom.